your host for today. As usual, all live events are interactive. Please say hello. Hi there, everyone. Ruby, Vicky, Charlene, hello. Good to see you all again. Please feel free to chat. Use the chat to talk about yourselves and banter. But if you have any questions, please pop them into the Q&A section, which is a separate section, so that we don't miss it and we can get to your questions. This session is being recorded and replays are available to our team and VIP subscribers. Alright, let me introduce you to our instructor for today. She is the principal of Paraji Advisors, specializing in private groups, and she teaches at several different universities for the tax law subject, and she's also a regular presenter for IPA. Please put your hands together to welcome Lisa Gray. Thanks, Joyce. Lovely welcome, everyone. Great to see everyone again. So I know you have a trivia thing for us about the song, the intro song just now, Lisa. Exactly. Joyce said she felt like she was in a bit of a horse's mood, which I guess is ready for today and things like that, doesn't it?
Cái này chị nghĩ là đâu đó cũng gần 2 tiếng đó tụi em. Cho nên em không muốn xem á, hoặc là em bận á, nãy em vô sớm đó thì em out nha, em không cần xem ha. Hoặc là em Phương cũng vậy nha. Tại bài này có 2 tiếng mà nghe.
Em có nghe hồi em bận nữa thì sao cũng được.
Got another one for Cup Day where a bit was strange by Just Melburnians. But yeah, it's a cover version. So Darren Braithwaite did not do the original song. The original song was by Ricky Lee Jones. So I never knew that. So yeah, famous Joyce than Ricky Lee ever did. And she actually likes his version. I remember her saying that. So yeah, one of the many trivia things that you know I like trivia. One of the many trivia things that I know. Yeah, Lisa is a trivia queen. For those that don't know. Okay, so what are you going to enlighten us about today? Well, this is our agenda for today. So we're going to just talk about rental deductions. We're mainly going to talk about residential properties and things like that, but we're going to really concentrate on deductibility, which is the important thing for our clients because that's what they want to be able to claim. That's a lot of the time, that's the main reason that they want to invest in investment properties to claim deductions and negative gear and those things. So we're going to drill down on what are corporate fees, which are a little bit of specialty. Interest, there was a few questions last week, Joyce, about interest, so I've embedded those into our slides so we can answer those. Land tax is a bit of a weird one as well. Legal expenses, repairs and maintenance, another bit of a weird one that we've got. And then we'll go through the ones that are deductible over time, borrowing costs, depreciation and capital works, and just make sure we know how they work, so to speak. And as you can see down there, we've got our awesome ATO guide that the ATO puts together every year, an update for us. And once we get to depreciation and capital allowances, I find that guide absolutely wonderful resource. So we've got that in the slides as well for you to do that. And we've got the link in the chat. Well done, Vicky. So there we go, let's move on. Let's look at rental expenses. Let's just recap what we were talking about last week, which is rent, which is expenses that are available for rent or, rented or available for rent. Remember we talked about last week what we can't claim as a deduction. And then we've got deductions are immediately deductible that we can claim when they are incurred, remember, on a cash sort of basis. And then we're going to look at some deductions that are available over time. They're the ones that we sort of have to explain a little bit more to our clients, Joyce. So that's what we do. So let's just have a look at the ones that are incurred. Now, what's really important with these ones, and we think about it, remember the last slide said if it's rent or available for rent. So if it's available for rent, we need to apportion it, as we talked about last week. When we go down this list, think about the ones that you pay for when the tenant's there, which is all fine. We don't need to apportion it. The ones that are covering the full year, we do need to consider that we need to apportion them. And they're the kind of ones like council rate and land tax and those sort of ones. Now, what I've done is I've put a little asterisk next to the ones. They're the ones that the ATO required to be specifically disclosed. So instead of just putting a schedule up that would be a little bit small, I think, for people to have a look at, that we've put the asterisk there to say, well, they're the ones that the ATO are expecting to see a separate disclosure for, and all the other ones we can meld into something like sundry items or something like that. And again, the ATO like the disclosures to be correct. A lot of the rental properties that they reviewed were wrong. It's just the disclosures were wrong. No harm, no foul on taxable income, but the ATO really like the disclosures to be correct. So be wary of those. And the ones that we'll look into in more detail are the ones that are a little bit more obscure. Right? Here we go. So yeah, they're the other lists. So this is pretty much a shopping list, a checklist, if you want to think about it that way, of all the things you want to ask your clients about, and whether they just prompts them to do that. And as you can see at the bottom, I put sundry. It's a catch-all at disclosure. That's where you put things. A lot of the times when we've got clients that are running the Airbnb type ones, Joyce, I put a lot of things in there because it doesn't fit anywhere else. So usually I stack the sundry items, but I do itemise it down. And remember that the ATO do receive that disaggregated data, the line-by-line data on individual tax returns do go all the way to the ATO, where on other types of tax returns, if you drill down onto a disclosure, it doesn't go there, just the label goes there. So be very, very wary of those ones. But again, just be aware, I think it's really important that we're looking at here are the ones that are directly to do with a tenant. You claim you don't need to apportion, but the ones that are carrying over a year, we do need to apportion on the available for rent over the 52 weeks for the year, and we do it on a weekly basis. So body corporate fees. Body corporate fees are one of those ones where I think I got a question last week. Do we actually ask for receipts if we get the income and expenses report from the property manager? And we should, right? We really do. And I think the property managers are getting much better. And as we looked at last week as well with the data matching, that data is going directly into the ATO without us seeing it. So the ATO do have that data. Whether they decide to share it with us on a pre-fill or not is another question. They've still got it, it still can come up in audits and things like that. So with body corporate fees, it's usually something that gets paid out of the income from the property. It gets managed by the property manager. And we're talking about, if no one's been in a body corporate before, or in an apartment or something like that, there's common property, and common property is owned by the body corporate, so it's all the individual unit holders have a say in the way that it works. So it's like, you want to call it, it's the sports club of the apartment block, and they cover things like body corporate fees, lighting, security lighting, security, insurance in the common property, maybe public liability, driveway access, all those sort of things, and any external maintenance, usually anything outside of the property, is all covered by them. And it's usually a quarterly fee. Everyone's probably seen that with rental properties. It's a quarterly fee that comes through. But sometimes what they have is they have this thing called a sinking fund as well. So there'll be a money allocated to just the electricity and the security and those sort of things. But maybe if the driveway needs to be redone, there could be a sinking fund where they go, okay, we'll put the money in. Now, if it's only for little bits for repairs and maintenance, so it gives the body corporate a bit of a buffer, that's fine, we can still deduct it, right? Because it's considered repairs. But what happens if the sinking fund is for something special purpose, like fixing the driveway or something like that? That's then got a little capital nature about it. And of course, every quarter you might have to put an extra $1,000 in, or your client has to put an extra $1,000 into the body corporate fees. That $1,000 is going to the driveway and it's not really getting spent. But that $1,000, not deductible. So you can't just look at the whole body corporate fee and say, yep, I'm just going to deduct that and disclose it accordingly in your client's rental property schedules. But if the money's taken out, then it becomes deductible. I'm the advisor for my clients as well. And so I say, look, if you're thinking about buying anything that's got body corporate, check the minutes of the body corporate. It runs pretty much like a company, board meeting. They have a meeting, it's a bit of a social club sort of thing. There's usually cheese and wine, and if you've been to one, and they make it really friendly, and you get to know your neighbours, and you get to know the people that are the investors of the tenants and things like that. So it's a really fun time to go to. But always pick up the minutes, because the minutes will tell you what the money's for. It should be on the body corporate invoice that we should get from our property managers. But again, always look in and drill in and just be aware of those little quirks when it comes to body corporate fees.
And Lisa, would it be like an additional amount? So you'll be able to see irregularities? Like 1 quarter is $2,000, and suddenly it's like $2,500.
Yeah, you do see that, Joyce, but sometimes what it is they'll go, oh, we just want a slush fund in case something big happens. Because as we tell our clients, with pay-as-you-go installments, for example, we go, you can find $1,000 a quarter, but if someone says, hey, find $10,000 at the end of the year to pay for something, people can't afford it. So that's the idea of it. But it's sometimes it's not lumpy, it's still even, just because you know the body corporate piece of that. And it's usually for older properties.
Cái vòng cổ như thế mà đem ra để cất này. Chị lên bị ao rồi mọi người ơi.
Hình như là mình đang rớt bàn hay sao á.
Chị Nhàn thử nhắn chị lên đi. Ai thử nhắn vào
Chị lên nói chơi, chị lên xíu.
để em nhắn cho. Nhắn rồi.
Hello. Tụi em chắc là bị lỗi mạng rồi.
thì nó là
Đợi tí chị ấy lại, chị share lại cái màn hình cho. Face after the maximum allowed connection, please reload this page. 30 minutes. Hồi nãy xem cái GST thấy được không em?
It's generating money.
Cái đó nó hơi khó hiểu một tí, tại nó hơi advanced một tí, nhưng mà nói chung là mình nghe để mình hiểu thôi, mình hiểu nó là cái gì thôi ha. Kiểu mình nghe mình biết được cái định nghĩa nó thôi, chứ mà để mà mình hiểu sâu thì mình cần phải học rất là nhiều năm. Nhưng mà tốt mình để nghe, thí dụ mình nhắc tới cái buôn bán business đi ha, thì nếu mà mình bán business on GST free going concern thì cái đó là GST free. Nhiều khi khách mình sẽ có những khách giống như là khách thơ như mình á, Phương nhớ không?
Dạ.
Đó là khách đó là khách bán business đó, em nhớ không? Là hồi đó ATO hỏi là tại sao lại không có GST cho cái Dream Pass đó.
Vâng.
Đó thì nó sẽ là trong những cái trường hợp đó, đúng không? Mình nghe cái mình nhớ rồi, trước đó mình có nghe cái bài đó rồi, mình có cái mình lật lại cái PowerPoint notes đó, tức là cái quan trọng của cái lúc mình nghe là như vậy nha.
Vâng.
Where does that go? How do we account for it? Well, the commissioner, the ATO, accepts that the proprietor can return the income derived from that in proportion to the unit holding. So it's every apartment's got a unit holding, and so you can return it. Because when you think about it, remember I said that those body corporate meetings are like a club? Well, that's what it is. They're a club. So the money coming in is a bit, it's from outside, but it's owned by the members of the club, which is the unit holders. So then they can actually get a proportion of that coming through. So instead of just body corporate fees coming in, it's actually coming in as well. And they can claim any relevant deductions, and if it happens to be any capital works or some infrastructure, in this case, it would be the tower would be put up and paid for by, your Optus and your Telstras. But that's the way it works. So remember, probably two things with this is income could come into the body corporate, and remember the mutuality principle, right? That it's all going to get shared around all the members of the club, like a board or a club or a sporting association. Great. And if you do come across that, there's the tax ruling that covers it. Because again, I've only just piqued your interest in it. It could be something that will come up with your clients. So interest and borrowings. Now this is the big one, and it is on the ATO radar. We know this. Okay, we've got interest on loans to purchase rental properties, deductible provided the property must be rented, available for rent in the income year to claim the deductions. Okay, so again, and with the interest, it's over time, so it's one we do need to apportion. So providing that the property is rented or available for rent, the interest charged on the loans, or anything to do with the income producing of property. We're talking about depreciating assets, repairs and renovations as well. So if you do have a loan and you draw down for any of those things, that is purely for income producing purposes. That is not for our holiday to Disneyland or wherever else Joyce is going on her next holiday. Vietnam, by the way. Oh, thank you. I thought I'd throw it to you because I knew you've always got holiday up your sleeve somewhere, Joyce. So you've got to apportion it for the private use. So again, this is where it becomes quite challenging. Is challenging the right word, or time consuming for us practitioners, where someone could taint the loan. Okay, and by tainting we're saying, do they pull it out for something like their new AV or their holiday to Vietnam or whatever? Because then forever they've pulled it out for a private non-income producing purpose. Therefore that side of the equation is non-deductible. So instead of just pulling the number out of the bank statement like we do, we then go, we have to apportion it and apportion it forever because it's forever tainted for that loan. And remember as well, data matching, the ATO are getting this data. They're getting the principal component and they're getting the interest component, and if the interest has gone, if the principal component's gone up, I'd be asking the question, what did it go up for? And that's what we would do as practitioners, as agents, and it's what the ATO is going to start doing as well. Now again, it might not be mischievous at all. It could be, no, we've put an extra room on, we've renovated the kitchen or something like that in the investment property, but you've got to ask the question if you see the principal go up.
So advice to clients, don't mix business and, not business, yeah, don't mix
Business and pleasure, are you going to say, Joyce? Yeah. Yeah, but it is. Please tell them not to do it. So have a great relationship with your client where they'll ring you before they do something. Right? Because the worst thing is, and that's why it's interesting when you look at the way I price my engagements as well, Joyce. I don't charge them for ad hoc phone calls. Right? It's more either on retainer or it's factored into a quarterly fee or something, because I want my clients to pick up the phone and talk to me, because 3 minutes on the phone is going to save me an hour of my time and an hour of my charge out rate to charge them as well, right? So I always go, and people laugh at me and say, listen, why are you picking up the phone to me at 6 o'clock at night? And I go, I'm just watching telly anyway, I might as well answer your question. So at least I know. So here we go. So let's look at some more unusual things about loans. So this is one that I expanded out because I touched on it last week, but I thought it was important. Again, I've given you the tax ruling if you want to drill down on it. But the ATO in their guide has said this complex loan arrangement. So they're talking about linked loans, split loans, and offset loans. So I've summarised the two most common ones, which is the offset facility versus the redraw facility. And I hope we're okay with what is what. Let's just explain it. So on the redraw with additional funds, okay, taken to repay the principal, cannot be withdrawn for private purpose, otherwise apportionate. So on a redraw facility, if I can explain it in more detail, what we're talking about here is you've got a loan and you put extra money in, but you can take it out, okay, without any penalties from the bank's point of view. However, from a tax point of view, they're saying you've repaid the principal. That's what we're saying there. You've taken to have repaid the principal. So therefore, you can't pull it out if it's for private purpose, even though you can without getting any penalties. So be wary of that. Don't put extra money into that. It's a bit like, what can we say, putting it away to superannuation. Once it's in super, you can't pull it out. It's the same sort of thing, if I kind of do an analogy with that.
I think if you pull it out, it constitutes a new loan. I think, that's the way I think about it.
Yeah. So it's interesting. It's the redraw. It's the redrawing. There's plenty of case law around it, Joyce, and that's what they're sort of thinking. And the same with the ATO account. Once you pay into the ATO account, you can't pull it back out, even if you think it's for another debt. It's exactly the same thing. Where offsets, this is what we're talking about with the offset funds, and this is the best one. You've got the loan that stays untainted, absolutely perfect, but of course you've got another offset account, another bank account that's linked to that account that then reduces the interest expense. So you can withdraw from that purpose because you're not going to take that loan. The mortgage itself, that loan facility itself, has not had anything different done to it. It's a linked account to it.
Yeah. And it's just sort of an offset, as in it reduces the interest. The interest is only calculated on the net of the principal less the offset amount.
So the loan itself is principal and interest, usually, Joyce. Sometimes with investment probably be interest only. So that payment still has to come out. But anything else is any other money, like salary and wages for your clients, go into that and then we'll reduce the interest expense.
And I also think like the money in the offset still belongs to the borrower.
Does.
Correct? Yeah, whereas the redraw, it belongs to the bank, and if you redraw it out, then it's like the bank has given you another loan.
Yeah, correct. And that's how it works, so it's considered that. The only way it won't be pulling it out for income producing purposes. So you can pull it out and invest in the share market. That's cool, right? As you can get loans and gear invest in shares, although probably you wouldn't want to do that at the moment. But I am not promoting financial advice. I'm not allowed to.
Yeah, but there's a reason why offset accounts are more expensive than redraws.
Right. Yeah. So so what I've done now is I've put in here, which is the questions from last week. I thought I'd just put it into a slide to explain it and get people to think about what it is. Because remember last week we talked about that the joint tenants are in a tax law partnership. They're in receipt of income jointly, right? They're not running a business, which is a common law partnership, right, where we can split it in different. So we're looking at the ownership on title as we were looking at last week. So we're going to split everything jointly, and I've thrown in a case. I'm sorry for doing that to everyone, but McDonald, and there's a tax ruling on what happens in this case, which is when you've got, what can we say, domestic relationships sort of mixing in all the group money and all that sort of thing. It's a bit like, can I say it, Section 100A and everything happening under the one roof. Please, I know that's a swear word, but I think we're all dealt with it. I think we're all over it now. I think we've all done our Section 100.
All in a pot together and...
Exactly, so it's all like with them. So remember that a private relationship does not alter or overwrite the respective entitlements. So think about like husband and wife or spouses, right, is not going to override the respective entitlement of joint tenants in receipt of income jointly as a tax law partnership. Okay, so if the title's in two names but the loan's only in one, remember it's the respective entitlement of the ownership of the property. They're in receipt jointly. So the loan is servicing both halves. So you can split it jointly as well. Okay? And that's what the ruling's saying. So just be thinking about it that way. Because in effect, I was trying to think about how to actually explain this like in common sense language, Joyce, when I was thinking of it. It's a bit like you could, if you've got two spouses, it's like someone's sort of got an unofficial, you've given half of the loan to them anyway. If that sort of makes sense. So that's what they're talking about, the private relationship. It's not going to override it because, in effect, they're a tax law partnership. Simple as that. Yep. And then the other one that we talked about last week was this. Remember, there's no partnership in property, so they're not in partnership. You've got the title in one name, but the loan is in both parties' names, and that's pretty common because, of course, the banks want as many names to be able to repay the debt as possible. So what can we do in that case? So that's another private arrangement if you think about it that way. But you can deduct it all in the one name. Remember, we're not going to split it because the ownership's still in one of the spouse's names, so we still can't split 50-50 even though the loan's in both names. Yep. But the big thing is, remember that this is interest, so it's an 8-1 deduction, so it's got to be incurred. You've got to prove that the owner has incurred the amounts. It was incurred by them. So how would you do that? I'm sort of thinking that the most logical thing is, did the income from the rent service the loan? And if that's the way, it's deductible to the one spouse. You don't have to split it. Okay, yep. So that's what we're coming. So I thought that answers, I think, the two questions we had. And these are pretty common ones, again, that we see. Two names on title, loan in one name. One name on title, loan in two names. It's just the way that the banks do it. And remember, banks aren't tax agents, even though they think they are at times. And don't even get me started on mortgage brokers and accountants' letters. That is a whole nother session and a whole nother therapy session for me.
Yeah. Can we just go back to that loan and the splitting one? Because I think this is probably the most confusing part of the whole session. So Ruby's asked a question here. I think it's good to sort of use an example, I think, at this stage. So Ruby asks, what if the property is under Mrs. name only?
Yep.
And the loan is under hubby's name only.
Mm-hmm.
And then she did a redraw of the funds to purchase the property.
She's done a redraw of the funds to purchase the property from the hubby.
I'm not sure, Ruby. Do you mind clarifying? I think maybe we'll just ignore the last bit. But in like
Not a redraw. Okay. Okay. So it's the same thing. So it's the equity interest. So it's the one spouse. It can't. The husband. So is the question: is it non-deductible at all, or is it deductible to the husband? Right. It's not non-deductible at all because for an income-producing purpose. Is it deductible to the husband? Well, what's his assessable income? Remember, this is an 8-1 deduction. Remember what we're doing. The first, when we go into a little bit check, first limit of 8-1 is it's incurred in your assessable income. There's a link to assessable income. So again, the McDonald and the tax ruling is saying private relationship does not alter or override any of the respective entitlements. So what we're saying is name on title is the only one that wants it. That's the only time we're going to look at someone having something in their rental schedule, and then you've got to work out what the other half is. Where it can become tricky though, Joyce, is what happens if it's only funding their half of the property.
Yeah, can you just do this example? So first, so Mrs. has 100% ownership of the property, right? And so she needs to put 100% of the rental income into her tax return. And then, but husband has the loan, and it's, you know, he's incurring interest expenses.
Yep.
Does he need to claim 100%? Like,
No,
did he claim anything?
She's claiming it.
Did claim it?
He can't claim anything because there's no assessable income coming in for him.
That's right.
Right? But for her, if she can prove she's incurred the expenses to him because it's a private relationship, and normally it's the rental income that services the loan anyway, Joyce.
Yeah.
Right? You see what I'm saying? That's where it comes through, so it is deductible.
Yeah, so because they're spouses, you can sort of, the way to think about it is kind of sort of, she's lending him, not lending, giving him some money from the rent for him to pay the interest. So it's kind of like she's incurring it anyway, and therefore she can claim it in a tax return. Correct. It's because they're spouses, right? She can give it to him for love and affection or whatever.
Yeah, like a gifting whatever. Right. So yeah, one thing about it that way. But again, that's why I threw the case and the tax ruling up, because it talks about all that, because it's sort of, well, even when we talk about, and I'm sure you've done sessions on divorce and things like that, it's all sort of pooled assets anyway.
Yeah.
Right? But what we want to make sure is the person that's on title is the one with the equity interest, and that's the one that goes into the tax return. There's no way person with the loan that's got no income coming in can claim a deduction because there's no assessable income to attach it to.
But this only works for spouses, yeah?
Absolutely, yeah. Absolutely. But again, this is where we've got these tax law partnerships, not common law partnerships. Because if it wasn't spouses, right, it'd be an arm's length arrangement with the loan, so you'd do it that way. And why would someone loan you the money anyway? Or they'd be tenants in common. So it'd be, Joyce, Vicky, Lisa decides to buy a property and we're going to buy it, 20-20-60 split or something like that.
Yeah.
And that's where you've got to look then at, is the debt covering just Lisa's 20%, or is the debt covering everyone's, and then you get into it. But it's only, as I said, it's isolated to a private relationship, and that's why I put that on the third bullet point.
Understand. Great. All right. I think I've held you back a little bit.
It's all right. It's fine, Joyce. That's why I thought it was good for us to have a discussion and there was questions in the chat, because it's one that always gets people a little bit confused, because it looks to us, if it was our business relationship, it looks slack, but because it's a private relationship, that's how it works.
Understand.
And remember as well, we've got some Part 4A, some general anti-avoidance rules if you're trying to game the system by doing prepayments. Okay, so trying to prepay interest early so you can claim the deduction for it. So just watch that if there's any prepayment of interest for any reason, and there's the tax determination on that. Again, why do you want to do that? Because this year you've earned a truckload of income, next year you wouldn't have. That's the way that it's working. Because remember, we're a progressive tax system. Okay, land tax. Now this is another one that's a little bit weird, and this is the one where you're going to get pushed back and go, Lisa, we're really going to do this. So remember what land tax is? So it's the tax that the state governments attach to property that isn't your primary place of residence. And it's not mayor's exemption, that the state governments usually use primary place of residence, PPR. Okay? And it's deductible because, of course, it's to do with income producing. And it's deductible in the year in which the property is rented, available for rent, even if an assessment does not get issued for a later year. And that's the problem with land taxes. You've got to get them and read them and look at what year is it attributable to. So if you don't get it till the next year, you're meant to, and this is where I get pushed back, you're meant to amend the tax return and put it in the prior year. I don't know who does that. You had a squire does that, Lisa. That's why I'm just telling you what the rules are, everyone. So when the assessment is in arrears and the land tax amounts are deductible in the respective income years to which the liability for the land tax relates. So that's what I'm saying. You've got to do it. Yes, Michelle's just said ridiculous rule. And it is, because it sounds like Michelle is very experienced in looking at these land taxes. And it is, it's all over the shop. And all of a sudden, I found that, say you've got it, capitalise it. Stephanie just said capitalise it. That's probably what you do if you don't want to do the maths. Just like deduct it anyway, like your mugs say, Joyce. Yeah, exactly. I was letting you do that one. So with the land tax, what happens as well is the SROs, the State Revenue Authority, seem to catch up with people as well, especially if it's been, say, their main residence and they've claimed PPR and then they've bought another one and moved into that. Sometimes there's a lot in arrears, and so this is the one that causes us a little bit of grief in terms of if we're going to do the absolute letter of the law right thing. Okay? So if the landowner receives a land tax assessment for a year, then later in the same year sells the property, there's no need to apportion the land tax, which is good. Right? So just be wary that there's not going to be a true up at settlement, which we were talking about before. So that's all a good one. And then if the property is sold, right, the recoverable amount should be declared as rental income by vendor. Okay, so a little bit different to rates, because remember it's to do with, you can think about it a bit like stamp duty, I think, but it's on revenue account. All right, legal expenses. What legal expenses are we likely to incur when we've got rental properties? So we're looking at, remember with legal expenses, it takes on the character of what it's being contracted about. So if it's about things on revenue, it's deductible. If it's things about capital, it's on capital. So you've just got to do that match up. So the deductible ones are all about generating rental income. So evicting a non-paying tenant, taking court action for the loss of rental income, all to do with rental income. Defending damages claimed for injuries suffered by a third party on the property, anything to do with that sort of thing. And then the capital ones are to do with conveyancing costs. We know that one. Purchasing or selling your property, resisting land resumption, so any of the other cost bases go in, and defending your title. And we know that they're the different cost bases. It comes to capital gains tax as well. So land resumption? Resisting land resumption. So that's the, it's a bit like taking title from you. So it's saying, I'm going to take 2 feet of your land because I need to put the Southeast Water or the Water Board wants to put a title through it, right? So it's a bit like defending your title, but defending your title is from a lot bigger things, but it's just saying, can we crib, an extra couple of metres because we need it to event road or something like that, Joyce, yeah. Okay. So repairs and maintenance. Again, we're concentrating on the ones that are a little bit different. So remember, we've got repairs and the definition of repairs, and this is one as well really, really highlighting the ATO starting to push back and question, even in the 2023 tax returns we're seeing, of repairs and maintenance are very high. They're going, your repairs and maintenance are high compared to your income, please explain, and they're holding up processing of tax returns, even this year. So this is really hot as well. So remember what a repair is. It's the wear and tear or damage from renting out the property. Replacement or renewal of a worn out or broken part. But remember, we're not replacing it in its entirety. Okay, so we're just fixing up, hole in the wall, bit of a damaged curtain because, the cat's run up the blinds or something. Someone's had a bit of an accident with the carpet or something like that. Now, maintenance. Remember, maintenance is keeping the property tenable. So fixing up paint and damage to walls and those sort of things as well. And then things that are capital, okay, that are not repairs and maintenance. So we're not going to put it in there. It's either going to add to cost base, it's going to be depreciating asset, or it's going to go to capital works. So replacement of the entire structure or unit of property. So we're talking about fencing, building, stove, kitchen cupboards, refrigerator. Remember, a whole kitchen is probably more likely to capital works. Improvements, reservations, extensions, alterations, anything that's capital. So I always think about it, something that can't be moved, likely to be capital. And then remember, we've got the initial repairs. So before you've even rented out the property, we're looking at fixing up defects, deterioration when you acquired the property. So that's when it comes down to how we allocate it all. And please make sure that capital is not putting in the repairs and maintenance disclosure, because as I said, the ATO are picking that up. And again, this is one where I desperately drill down on property managers' reports, because you know what they're going to do? They're going to throw it all into R&M, aren't they? Definitely. So therefore, you've got repairs and maintenance. So therefore, you've got to ask for receipts. But if it's bigger, maybe the income doesn't cover it anyway. So you know that your client would have had to pay extra, and they know exactly what they paid for. Yep. So the repairs, the timing. Now remember that the repairs is a specific deduction, and it's not an 8-1 deduction. So the timing is a little bit weird when it comes to repairs. So the repairs to a rental property will generally be deductible if the property continues to be rented on an ongoing basis. All good, we're absolutely perfect with that. Or the property remains available for rent, but there is a short period when the property is unoccupied. So unseasonable weather causing cancellations of booking, or advertising is unsuccessful in attracting tenants, cancellations, those sort of things. Now repairs to a rental property will generally be deductible where the expenditure is incurred. Think about the timeline. In the year of the income that the property is held for income producing purposes. Even where the property has previously been held for private purposes, and some of all the damages attributed to when the property was held for private purposes. And that was the one where light bulbs went off for me. Right? Because that's counterintuitive. We think it's got to be linked. We get it drilled into us so much, saying available for rent, it's, initial repairs you can't claim, and all this sort of thing. So what you've got to watch out for is the timing of it all. Right? Let's just do this one, and I'll give a quick example if I've got time, Joyce. Is repairs to a rental property will generally be deductible even when the property is no longer rented and the need for the repairs is related to the period in which the property was rented and the property was income producing during the income year the repair costs were incurred. Alright, so where is this? If you're following the bouncing ball on the timeline, we're saying to be able to claim the deduction for repairs, you've got to have assessable income in that income year. So where is it going to cause us grief? Think of 30 June as our time in the sand. It's also my birthday, but don't go there. The time in the sand, 30 June. So you've got to then look at it and go, okay, what can happen? Now, we know property developments take over 12 months, agree? If you've got a client that's doing property development, I'm in an area where there's so many houses getting knocked down and back up. It takes about 18 months of inconvenience for me in the street and having tradies around and all that sort of thing. So think about what will happen. So you've got a client being a rental property, and they've decided to move back into the rental property because they're building their big McMansion on their own property. They're knocking it down, their main residence, and they're going to build a beautiful, beautiful new home on it. Say that happens on like the 1st of June. Okay, so you've then got repairs that you want to do. You've got to do those repairs. Your client's got to do those repairs in the month of June because that's when the income was coming in. Because the next year, it's highly likely there'll be no income coming in for that year because the build's going to take 18 months, let's face it, right? So therefore, if they try and do a repair in July, based on this, they can't deduct it, and vice versa. So just remember that, and it's very much on that crossover. So again, make sure you've got good relationship with your clients and you know what they're doing, because this can easily be fixed. Because, and this is a little bit counterintuitive to what we think. We think it's to do with the tenant, we can deduct it. But this is the timing, and the reason the timing is a little bit bizarre is because it's not an 8-1 deduction, it's a specific deduction for repairs and maintenance. And just, yeah, cool.
Alright, what's the immediate deduction threshold? There is an immediate deduction threshold, yeah?
Well, you're leading in. They are not even because they're down to $300 like we are if we're doing work-related deductions, Joyce. So that's what we're right up to now. So we're doing borrowing expenses, we're doing capital allowances and capital works deductions, Joyce. So we're back at $300. Right, remember when instant asset write-off we were going for temporary full expense, we're going beautiful, we don't need to worry about capital allowances anymore. And remember, if you're in business, you've got 1,000. For these guys, they're not in business. We're back at 300 like we are for work-related expenses. Okay. So borrowing expenses. How am I going for time? Am I doing all right? For borrowing expenses. So remember, borrowing expenses aren't interest. First thing, it's all the other expenses to do with borrowing. So loan establishment fees, title searches done by the lender, mortgage broker fees, LMI, lender mortgage insurance, all those things are borrowing expenses. And they're capital, right? Oh, what's not borrowing expenses? Insurance premiums on the loan for death and disability, interest, and various stamp duty on different things. Okay, we're going to add that to cost base. Yep. So for the calculation of borrowing expenses, because it's capital, we need to do it over time. Remember, this is one of the ones we finished up with all the immediate ones. We're now looking at deducting it over time. So if the borrowing expenses are greater than $100, we need to spread it over 5 years or the term of the loan, whichever is fewer, whatever is less. Okay? Is less or fewer? I always get confused with those two words. But anyway, so 5 years or the term of the loan. Now, the term of the loan is probably going to be over 5 years. So that's what we're going to do. If they're under 100, we'll just take it straight away. They're usually over that, but they're nowhere near as... This used to be a big cost years ago. Now, there's a lot more competition in the market. So that's what we're doing. So if the loan is less than 5 years, you just... you claim, if you repay the loan early, less than 5 years, you just claim it all in full anyway, okay? And if the loan is part through the year, you just take the first year will be a portion based on number of days. So this is one of the annoying ones where you've got 365 and 366 to do all your maths. So this becomes a bit of a maths exercise, but that's why Excel is our friend. Excel is our beautiful work paper. I love Excel. All right, so that's how borrowing costs work. We're just really wary of that. So depreciation in capital works. Now, Joyce thought about this and said, what is the number now? And it's $300, right? So remember this, we've got to do for anything over $300, they're depreciating assets. So the decline in value, remember you can deduct amount equal to the decline in value for new depreciating assets that is held at any time during the year. Remember there was that little thing that came through, what was it, 2017, 2018, about then, where second hand, you can't deduct for second hand any longer. So that's why we're saying they're new. Oh, okay, right, and that's what it was, right? So it's from 2017. The deduction is to reduce the extent of installed for residential properties to derive rental income from second-hand depreciating assets. So it's just people being a little bit cheeky, and the laws were changed because people were being a little bit cheeky. So second hand, we can't claim them for second hand. Installed and ready for use by another entity, except where it's trading stock, or in your private residence, which is what the real mischief was about, or for a non-tax purpose. Okay, so that's what second hand's considered of. However, what happens if you buy a new residential premises that includes depreciating assets? Like they have lost the I. Sorry, I quickly added including depreciating assets. I added that when I was fixing up the slides the other day. Okay, so think about a new residential premise when people buy off the plant. Because when you buy off the plant, you've got your stove and you've got your hot water service and you've got all those things in there, but you're not buying them directly from Harvey Norman, JB Hi-Fi, all those places, are you? So are they second-hand and can you claim a deduction for it if it's an investment property?
Yes,
You should be able to think about the rules, okay? So a new residential property, they said if it's new residential, and this is GST definitions if anyone's interested, newly built residential property from a developer, purchase a residential property that's been substantially renovated. That's the definition of new residential. Deductions are allowed, right, if no one is permanently entitled to the deduction for the asset, right, and either no one's resided in the property before purchase, or the asset was installed for use or used at this property and the property was purchased within 6 months of it being built or substantially renovated. Right? So you can still claim it. So the thing is, property developers usually hold everything on trading stock. That's why I emphasised trading stock before. And the 6-month rule allows for, if you've got a big estate, sometimes one of the properties someone's living in, is sort of looking after and trying to sell it as well. So that gives you that 6-month rule as well.
Understand.
All right, so you still can do it. So don't go, oh, you haven't actually got the receipt from whoever you bought the fridge from, or the stove from is probably a better example. So once we've got the depreciating asset, what are we going to do? We've got different options. And remember, we're a little bit out of practice of doing depreciation or capital allowances because we've had temporary full expensing and things like that. So we've got diminishing value, prime cost, and we've got to work out what the effective life is. Okay? Now, the Commissioner does a determination every year. For those of you who have forgotten that they do them, and maybe we've got to get back doing them because our instant asset write-off is only $20,000 now. So we've got to remember about the Commissioner. The other thing that I do is, this is why I love the property guide that the ATO put out every year. They pull out all the relevant ones out of this guide and this tax ruling, and put it into the guide. So hot water services, air conditioners, carpets, curtains are all in there, and they update it every year. So instead of delving through there, which is now not a PDF, it used to go on for hundreds of pages, it's all online. The one good thing with the rental property guide as well, it's a PDF, so you can have it on your desktop and just do a control find on it pretty easy. Now remember, we're doing it for, this is the magic number, Joyce, of $300, providing it's not part of the set. However, what do? I love my property surveyor. Check that they're TPB registered and make sure that they've done it all. So all of those ones, I just look up all their numbers, check that they're registered with the TPB, because then they're a tax agent, which means I can be pretty comfortable, I can rely on them. And they're going to do the valuations on all the assets, and we're just going to put the number from it. Okay? So the only thing then we need to do is think about what are we going to do with the additional ones after purchasing property. And those reports are getting quite reasonably priced, and of course those reports are also tax deducted to our clients, so just tell them to go and do them.
I might just get some audience participation in terms of who they go to. Just sharing some insights and insider experience. The only one I know is like BMT. That's a common one for consumers, residential property. So feel free to put in other that you
that was the used before. Yeah, the originals were BMT. Yeah, BMT. But there's plenty of them out there now. There's a bigger suite of them. So who else is? Catherine's uses BMT. Anyone else use any of the others? BMT.
Seems like it's still the go-to.
Well, it's still a go-to. But with the competition, they're nowhere near as expensive now. Yeah, Jacinta's only said that we have MCG for our grad program. Okay.
Yeah, MCG Quarterly Survey is one of our instructors.
There you go.
Mr. Depreciator.
Yeah, exactly. So there's plenty of them out there, which is great. And use them. And Duotax, Kylie, yeah. So there's plenty, as I said. Net capital claims, great. There we go, Joyce, there you've got some.
And they're really good because they help to distinguish between capital allowances and capital works, which
They do as well.
it's hard.
And that's what we're heading into with the construction. And once we get construction, you'll see why we need someone that's got expertise in it.
Yes.
But the two that I go to, Joyce, is anything to do with R&D offsets. I go to an R&D tax agent that knows exactly what they're doing. And for quantity surveys, for evaluations, I make sure they're registered with the TPB. And then I go, okay, I know that they're under the same scrutiny as I am. I can just pick them and place the number in. And that's what I want to be able to do. So another thing I thought is just mention pooling quickly. Remember we can pool? I don't usually pool for my rental properties because it's just a one-off and I just deal with it as we go. But remember with pooling, and for those of you, remember these are not in business clients. So the pooling rates are different. We're used to 15 and 30 for our small business clients. These are 37.5 and 18.75, so our big clients. These are the ones that Joyce and I used to play with way back, that our bigger clients. So remember, they're not in business, so that's what we've got. So we've got low-cost assets in low-value pools. Okay, so a low-cost asset, less than $1,000, and we've got our low-value pools. Okay, so just remember that's how it works. Again, I don't usually use them. I use it on I do an asset-by-asset basis because normally my clients have, just changed over a hot water service or an aircon or got new curtains in, and it's pretty easy to do. So I just don't worry about the additional issues that pooling can cause. If you use a pool, once you use a pool, you've got to use a pool. You're stuck with it. Exactly. So now construction expenditure. And this is really interesting. So remember, capital works deductions cannot exceed the construction expenditure. Yeah, Melissa agrees. She says, I hate pools. Yeah, that's why I do it on asset basis because there's traps on it. It sounds good and it sounds like a shortcut, but like any shortcut, don't even start me on the revised fixed rate method. It makes it harder for us. Okay, so Tony said the construction expenditure, no deduction is available until the construction is complete. So after 87, it's the 2.5% method. I love the way the legislation's written. The 2.5% method, 40 years. And deductions are based on the expenditure applied to capital works such as anything that you can't move, an immovable object, patio, garages, all those sort of things. Driveways, I think I use driveways as an example, with the body corporate, those sort of things are attached walls. Okay, and that's where our friendly quantity surveyor, I'm sure they don't wear hard hats, but otherwise they look like a politician. So that's what we do. So we use them because changes of ownership, and this is where it gets tricky, everyone. So changes of ownership, and sometimes previous owners of the property might not have the paperwork, or previous accountants might not have the paperwork. Who knows? So where the ownership changes, the right to claim any undeducted amounts passes to the new owner. It's not like you reset construction costs. Whatever, if it's gone through 3 hands of owners, you're carrying on their deduction. So you've got to somehow get. If you can't get there with their paperwork, that's why your friendly quantity surveyors are going to help you, right? And that's why we use them. So to be able to claim the deduction, the new owner must continue to use the building to produce income. There's no capital works if it's not linked to earning assessable income. And the previous owner was allowed capital works deductions. The works deductions after 92, they are required to provide to the new owner information that will enable the deductions going forward. Good luck, everyone. But they're required to do it. I don't know what the penalties are if they don't. I think you just ask nicely. And where the property was not previously used for accessible income purpose, the owner's disposing of the property does not need to provide it. So it's only if it was using for income producing purposes. And again, that's where our quantity surveyors come into play. And then I think this is nearly my final slide. It is indeed. Cost-based adjustments, remember this is what it is. Depreciating assets, we're all good with, right? With capital works deductions, remember we're going to adjust the cost base. It's not a free hit, we do need to adjust for it. So it gives us the deduction for negative gearing the properties, but when our client sells it, it's again, we've got to do this correction. It's another thing the ATO are looking at because they're saying the disposal of these properties, the calculation is wrong, and this is one of the reasons that the capital works deduction isn't corrected for. So remember, working out the capital gain or loss, the cost base or reduced cost base of the property, I hope you don't get reduced cost base, may need to be reduced to the extent that it includes construction expenditure for which the capital works deduction has been claimed. Now the deductions claimed are excluded from cost base acquired based on those dates because as we know with capital gains tax, it's all date driven. So remember, if you've got capital works, we've got to do the correction if our clients then dispose of the property, and that's why again it's very important that you put the capital allowances in the right label and the capital works in the right label. Okay, because if you put the capital works in the wrong label or whatever, remember that's already been given to the ATO, so they know what the adjustment should be because you have reported it to them through your client's tax return. And is deductions, Joyce?
Oh, massive.
Closes to them, which is great. Joyce is always worried that I'm going to go down a rabbit hole, everyone, and start telling me stories, which I love telling you because I love talking about tax and all the great stories that I've got from my clients. But yeah, so I thought that was a good 1 hour of deductions and all the little weird things that deductions are which aren't obvious. So I've tried to pull out just those little nuggets of wisdom. Joyce?
Amazing. Yeah, I love that it has something for everyone at, whatever level you are. Great. Sorry, for those that need to run off, while we're doing Q&A, would you mind filling in our poll and rating before you run off? Thank you. All right, we have 12 questions, Lisa. So engaged audience today.
Sorry, I might have to get my buzzer out, Joyce.
So are you alright to stay for 15 minutes?
Absolutely.
We'll try and get through all of them. Okay, Vicky has a cheeky one. With the $300 threshold for capital allowances deduction, immediate deduction, can we get a $600 immediate deduction if the property is jointly owned?
No.
I thought so.
Hello. Remember everyone what we do. So on the rental schedule, we've got available for rent days. It doesn't apportion it, but remember we've got gross, and then we've got our proportion of it. So it says percentage of ownership or something. There's a box that says percentage of ownership. So what we're looking at with all our rules is in the gross column, and it allows for it.
Yeah. A next question from Wendy. I'm also always confused about this one, Wendy. If you are replacing the carpet in a full room, would that be a repair or would you depreciate it?
We're going to beautiful case law, Wendy. It's talking about if you replace it in its entirety, it's not a repair. So, I'm sort of going, if you're replacing a room, and that's the one that's worn, is that the entirety or not? I would say if it's...
Ủa cái này không có subtitle hả tụi em? Có.
Replacing a room because of damage, you might be able to get away with it, but that's the rules, entirety. And you can't, even if it's a repair, you can't improve the functionality of it. So you can't go putting in more carpet. But yeah, we'll get there. So yeah, I think that's one where it's a little bit of a grey zone for a room. Like full house, yes, definitely entirety. It's got to go to depreciating asset of carpet. I think carpet's 10 years or something. But if it's a room, I'm thinking, why did you do the room and not the whole house? I think I'd do that. So, yeah. What do you think, Joyce? That's how I feel about it. Yeah.
I feel like it's a repair because
Yeah.
why wouldn't you do the whole house then?
Yeah, why should do the whole house? I think that's
Yeah.
yeah. Definitive as with all these things, just on a case, depends on case by case. That's all.
Another we've got lots of depreciation questions, Lisa.
Oh dear.
Gonna test your grade.
I might have to go. Oh, I'll take that on notice.
Vicky asked, so initial repair, new roof. Is that still deductible at 2.5%? Where it is constantly rented.
So a new roof is capital works.
Mm-hmm.
Yep. Yeah. So 2.5%. Yep. Over
Yeah, but I guess it's like what constitutes an initial repair?
Well, officially the initial repair is you haven't used it for income producing from when you took ownership of it.
But roof will never be a repair, right?
No,
Roof will always capital.
tile, yes, right? But its entirety. So that's what you've got to ask yourself. Are they replacing everything's entirety? And this is where I get annoyed because you're looking at it and going, it's economics versus tax, right? If you repair the dishwasher, it's going to cost you more than replacing it. But if you repair it, it's deductible. If you replace it, you've got to depreciate it. So you've got to make that call.
So many depreciation ones. I might try and change it up. Okay, what's an asset? Another depreciation one. By Dallin, what's an asset's written down value drops below 300? Can you write off the whole depreciating asset?
Oh, that's sounding like it's a leftover from low value assets, low value and writing off pool balances, doesn't it, Joyce? No, Alan, it's the purchase price. Because remember, with depreciating assets, even if you're apportioning between private and income producing use, I only said business, so we're not doing that, but private and income producing, it's the cost of the whole asset, not the proportion that you want to deduct. So, no, yeah.
Good try.
Good try, though. I like the way you're thinking, and I think that's what's interesting, Joyce, with everything that we've evolved from, is you've been doing it because that's what you like to do, but sometimes you need to go back a little bit to the first principles and go, well, why do we do it that way?
Yep, it's more for convenience, that $300 threshold, and so, yeah, having to then write it off, do another separate calculation to write it off, it's very inconvenient.
Yeah. Although if your client does not have that asset anymore, of course you're going to write it off. But if they sell it, you don't have to go there. All right, we won't ask for that one.
Hey,
Yeah.
hey, painting, repair or capital works? Again, in its entirety or not?
Yeah. Painting your entire house is capital works. But if you're just painting a room, why are you only painting a room? It comes down to the cup question, really, doesn't it? So use your professional judgment, but you are not going to be able to argue repair if you're painting the entirety.
Yep. In terms of maintenance and keeping the property tenantable, would that include gates getting replaced for security or for roof damage causing leaks?
Yeah, so they're all repairs. New gate. New gate. It's pretty much capital works. You probably just sneak it through. I say that. But sneak it through. I'll probably sneak something like that through. Security system. I sort of things, and that's all capital. And depreciation is capital. Yeah, everyone's laughing at sneaking it through. I'm just going, it's how much is it really going to cost?
Okay, I think that's enough for the depreciation of the phone. I think Lisa's a bit,
That's all right. Look, the questions everyone's got, and that's what it is. But
yeah, we'll give you a break from the depreciation and move on to things like interest deduction.
oh yeah, the other.
Someone asks, is a way to think about the redraw facility like increasing your credit limit?
But yeah, is it increasing your credit limit?
really? No?
think so. What we're basically saying is, if with the redraw facility, you've paid it in to reduce your interest amount, but you consider that you've paid the principal component. You haven't prepaid the interest components. Basically, you're trying to pay the loan off earlier.
Mm-hmm.
It's as simple as, I think it's as simple as that. Yeah, that's why redraw bad, offset good.
Yeah, more flexibility with offsets, so it's worth that, you know.
Correct. It's still getting the reduction in the interest, which is really what you're trying to do. But then you've got clients that say, I want a big interest expense because that's deductible. So I'd be hoping that putting all their money off their main residence and not their investment property in mortgages.
Mm-hmm. Moving on to interest and, you know, splitting it between different owners, etc. Wendy asks, okay, if it were, say, father and son relationship instead of husband and wife, would the family relationship rationale still apply?
I'm assuming that the son's gone to the bank of mum and dad. Is that sort of what we're sort of saying?
It's more like just one party went to the bank. I think, yeah, maybe both father and son owns.
I believe as long as it's a related entity, it still holds up.
Yeah, family is still
family's
a relationship.
Yeah.
Yeah.
And that's what it is. So, yeah. So it's anything that's basically a related entity or any family relationship.
Great. And I think that's a similar question that Dallin asked, so hopefully, Dallin, that answers your question too. Otherwise, feel free to ask that again. And then Dallin has asked a question about that body corporate income being derived from a mobile phone tower through the body corporate. Is that classified as rental income?
Well, yes, it is in effect. And so I think the question is, if it's coming through, you're going to put it in other income. So in the rental schedule, if this is where the question is, the disclosure, there's rental income and then there's other, and so you go into other.
Mm-hmm.
Coming in from your body corporate invoice, if I can call it that.
Yeah. So pick up the gross. Don't pick up the net.
Gross, yeah, exactly. Joyce, don't net it off. ATL, take netting off, so you pick it up. So what will happen is, this is where you've got to be careful with your body corporate. If it says it's $100 this, and that's all they've paid, is it $100? Get the receipt and find out, has there been $1,000 of income come in and then there's been $900 worth of normal expenses come through. So make sure you always, we rarely net off in tax.
Yes. Yeah, for the disclosures, for sure.
Yeah, rarely. It's always assessable income minus deductions. The only thing I can think of is about it. That's too detailed.
Jatinda has asked, interest claim on construction costs while rental property is being constructed. Understand that it can't be claimed on vacant land.
Mm-hmm.
Has the ATO finalized tax ruling 2021 D5? Not sure when that is, do you?
Take that on notice. I have done up. I'm not sure if they have. I think the process of trying to finalise, I don't know if that's the one you're talking about, but it's the one about construction and interest expenses, which I'm assuming it is. I think they're looking at finalising it. It's very close. I think I've seen the final draft, but I'm not sure.
Yeah. Assistant Nugget, please make a note on that one, and then we can drop that into the comment box under the video.
Yep, no, I need to look that one up, Joyce.
Yeah. So, Vicky says that in terms of she uses the depreciator, which I assume is MCG POS or BMT, and new oven purchased.
Yep.
Another bought 2 years later. Manual adjustment to depreciation report.
Well, are you saying that the first oven was in the quantity surveyor's report, report, and the second one you bought?
Yeah, like
Therefore, it's going to be really hard to find it, isn't it, if it's in the pool? It depends what you've got. So if it's owned by item, you need to basically write it off completely because I'm assuming you haven't sold, your client hasn't sold. And then what I would do would be the new oven, I just claim it separately outside of the quantity surveyor's report. Right, but I'm just concerned if you've taken the option, because usually in the quantity surveyor's report they give you diminishing value, prime cost, pooling, they give you every single option, and you just plug out the number which you're going to use, and then you've got to keep using that table forever. You can't go changing your mind, everyone. So you use, most times we pull out diminishing value, so it front ends the deduction. That's what we do to claim a bigger deduction. My concern with the new oven, if it's in the quantity of the original oven is in the quantity surveyor's report. If you decided the pooling option, how do you know what the termination value is? That just concerns me a little bit. So I think that's in the too hard basket. I would ignore it and just keep doing it and just claim the oven separately.
Yeah, but if the, like, what's the 1997 rule that like would the new oven not be appreciable, or
New oven. Oh, it's a new oven. It's okay. So for some reason that's the point, and you charge the oven in its entirety. But I think what the question is that the original oven is still getting depreciated through the quantity surveyor's report. How do you extract the termination value out? That's because I'm sure that it would be disclosed, like, yeah, sometimes they do, I think Vicky's answered this one for us, sometimes they do put a detailed list of it, that was the only thing I was thinking of, Vicky. I was thinking maybe it could have been in a pool and then you wouldn't be able to see it individually, which is always the problem, that we can't, we've got all our pooling back for our general business clients as well.
Yeah, but if you can find it in a separate line, it's just such a pain to have to then exclude it every year. So my shortcut method, recommendation would be continue to just use the QS report and not claim the new oven. At least that's conservative.
Oh, that's true.
Just to save you a bit of headache. But depends on your client, right? So if they're very pedantic and they want to claim every single cent, you wouldn't do that for those sort of clients. But clients that are a bit more relaxed about it, you can just explain to them. But it would have taken hours.
The quantity surveyor's report done.
Yes.
It costs a couple of $100 or something, or more, maybe. I don't know.
Okay. Got 2 more questions. Oh my gosh. Can you do 2 more questions, please?
Of course.
Amazing. Thank you. One last one from Dallin. It's the interest one. He says, my question about interest is more about, can you choose to not split interest 50-50 for a joint tenant property where the loan is in only one person's name?
No, it's always got to be in the title. Got to be split title.
Start with the title first, yeah?
Up the title first. The only reason that it wouldn't is if it's joint tenants and they've bought a property for $1 million and only one person has borrowed $500,000, you can tell that's only their side. So it's the purpose of the use of the loan. Let me put it that way. So it's the purpose and use of the loan that determines the deductibility, not really whose name it is in those situations.
Understand.
Yeah.
Right? Depreciation question from Balachandran. I hope I said that correctly. Electrical work is done 1 week at a cost of more than $300 prior to the commencement of rental. In this instance, do we claim this immediately in the current year or depreciate it as capital work?
So
Electrical work.
electrical work, so it'll be an initial repair and be capitalised, I would have thought, it sounds like, by that scenario. So remember, it's usually, or it's available for rent. So the issue I've got, I don't know if I said this last week, but with Airbnb properties, they've got to at least advertise it before they can start claiming the deduction. So just watch that. I have a whole series of expenses, and then I put a big line through it saying when was it available for rent, when did you start advertising it, and that's where the line goes. Everything above that line.
Security doors installed renting out the property. Also, but what else?
Capital, epoxy flooring. Epoxy floor. Now, let me just understand. What's epoxy flooring would be like staining floorboards. Is that what epoxy is? It'll be some sort of protection, won't it? To seal it. Melissa, thank you. Melissa says it's to seal it. Floor? Wouldn't you get that after you've polished your floorboards? So if it's in the entirety, again, if you get your floorboards done, it's the whole bang lot, because I did those during COVID. Here we go, Dylan. We're getting some great developers. Dylan says, very experienced. Instead of polyurethane, Melissa said. Oh, great. But it's an application, isn't it?
It sounds like you gotta like paint over it. Yeah.
Application. So
That's
therefore,
the capital to me.
let's do it parallel to painting. If it's in its entirety, it's capital. If it's a repair, it's not. You could be powerful too. Thanks, Melissa. I'm getting some renovation delights. Thank you. Thank you so much. I've got some people that love doing all this stuff. Okay, so again, if it's in its entirety, it's capital. If it's just doing a repair, also if it's improving it. So if previously didn't have, say it was just normal and they put the floorboards, floating floorboards in to secure it, to change the character of it, it's capital as well.
Okay, Vicky, I won't answer your question, which you sent at 1:46 p.m. I'll answer the one before that. So Vicky says the 600 write-off could be available if it's jointly held, and she put a link in there. So we might take that one offline and get back to you on that one, Vicky, if you don't mind. Yeah, you can. We'll also just look at your other question, and then we might get back to you on that one in the comments of the replay as well, because that one's a bit long from the looks of it. But that's all we have time for. Thank you so much, Lisa, for staying an extra 20 minutes to get through all our questions. But if I may, just one final key takeaway from you before we say goodbye to everybody. And for the rest of you, feel free to chime in as well. What was your number one key takeaway? Lisa?
Okay, my key takeaway from this is, I've got two. I think the most important one is to drill into what the property manager's income and expense report is. Just don't go blindly by what's on a nice bit of PDF. Actually drill down and make sure you've got the receipts, because this is a hot topic. Because interest, we already know, is a hot topic. That's what I think it is. And be really cautious of repairs and maintenance.
Wonderful. For me, it was all about the interest and the ownership and the splitting. Very, very confusing. But I think the rule about always check the ownership, and usually that drives the interest deductions, particularly for private relationships. Amazing. Thank you so much, everybody, for joining us today. Thank you for being such an amazing audience. And please put your emoji hands once again together to say thank you to Lisa Gregg. Amazing presentation today, Lisa. We'll see you next time, everybody.
Thanks, everyone.
Chị ơi, hết rồi, em out trước nha chị, nhàn tí có gì chị lên vào thì chị báo giúp em với nhá.